The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
A very warm welcome to Squawk Box Europe. I'm Steve Sedgwick at the Ambrosetti Forum in Lake Como. And of course, you've got Juliana Tattelbaum in the studio. These are your headlines. Trade and defence topping the agenda as leaders gather on the shores of Lake Como for the European House Ambrosetti Forum. Nobel laureate Joseph Stiglitz just tells me on Europe Early Edition that Europe should have done better in trade talks with the United States.
Europe should be paid to trade with the United States rather than the other way around. Europe should have gotten the better deal. Europe got a bad deal. Absolutely.
Markets continue to raise their bets on further Fed easing ahead of today's U.S. payrolls print, lifting the S&P 500 to a fresh record and pulling long-term bond yields back from this week's multi-year highs. And Ukraine's allies agree on post-war security guarantees with international troops to be stationed on land and sea, but admit there's still a way to go towards a peace deal. Well, happy Friday, everybody, and warm welcome to the program. It is the day investors have been eyeing all week. U.S. August non-farm payrolls are due this afternoon as traders increasingly firm up their bets on a September rate cut. Analysts are expecting the U.S. to have added 75,000 jobs in August, up just 2,000 from July. Meanwhile, the unemployment rate is forecast higher at 4.3%. Now, critically, this will be the first jobs report since President Trump fired the head of the Bureau of Labor Statistics after he was unhappy with the data last time round. Let's take a look at bond markets and where things stand right now in the lead up to this report. We have seen a rise in bond yields across Europe in recent trade, but interestingly, U.S. bond yields have done much better. And actually, if you look over the course of the year, 10-year Treasury yields have actually fallen despite all the concern around Federal Reserve independence. We have seen outperformance of those Treasury yields compared to European bond yields. Here you have the 10-year currently trading around 4.15%, the 30-year U.S. Treasury yield trading around 4.8%. And now, in terms of 30-year yields across the globe, here's where things stand right now. We have, of course, seen a major move higher in gilt. The 30-year gilt currently trading around 5.596%, phenomenon which Andrew Bailey has chalked up to global forces. Clearly, the domestic picture is also at play, underpinning the move higher in gilt. 30-year French bonds trading around 4.4%, Steve.
Yeah, Juliana, missing you. Well, actually, no, I'm not. I'm really on the lakes of Como, and it's actually rather lovely. Look, really fascinating what you were saying about the bond market, and I couldn't help but concur that when you look at the US 30-year paper trading around 4.85, way off those highs and those concerns about 5% and those multi-decade highs we've been seeing, actually the pressure's come right off with trading levels that we haven't seen since mid-August as well. So I did actually speak to Joe Stiglitz about this very issue. Of course, Nobel laureate and professor at Columbia Business School. Why don't we just listen in to see what he had to say about the bond market?
I think we'll be able to finance U.S. government interest rate. Real interest rates are significantly high. There's a number that they calculate of what is the real interest rate projected forward 10 years. So that is the real cost of the government, and that is up substantially from like 2 to 2.5. So those that's a real indicator of market not thinking things are being well managed. And let me tell you, I agree with that perspective. And I think markets are slow to react. That is to say, they haven't fully taken on board. For instance, Trump claims that tariff revenues are going to finance the deficit. What he doesn't understand is it takes a while for firms to readjust their supply chains. And so in the short run, you have your old supply chain and you're paying your tariffs at the high rate. But, it's like gravity. firms are going to find the way they can import goods at the lowest tariff. And as soon as that happens, tariffs go down.
So, of course, we're all looking for indicators that the new tariff regime that has been in place pretty much 6 months now, certainly that's when we had the Liberation Day announcement. We're all looking for signals about whether or how it is affecting the US economy. Is it creating a problem on the jobs market, on the consumption market? Is there much more inflation coming into the system, and what it means in terms of US asset classes? Joe was also talking, of course, Juliana, about the weakness of the dollar and how he expected that to persist. The latest bit of data, of course, is the payrolls today as well. And it's very interesting that the truth of the matter is, so far, there is no doubt we are seeing a continuation of the trend that there is slowing job creation in the United States. But there is no red flag at the moment. Plenty of amber signals potentially if you're looking for doom and gloom. But in terms of the data across the board, whether it be consumption patterns, retail sales, even to a degree some of the inflation data, there is no startlingly red signal that is saying this is happening because of tariffs. And so it's actually really interesting that some of the more gloomy analysts out there are having to say we just haven't seen those big signals just yet. Will we see it in the payroll? That remains to be seen, Juliana.
I think that's a pretty fair assessment, Steve, that we've had some amber signals, especially this week. When you look at the ADP data, which came out yesterday, it was weaker than expected, but nothing to really cause panic in the market. But my sense, based on the conversations we've been having with strategists and economists over the last couple of weeks, whether the market interprets a weak report as good for markets or bad is really going to come down to just how weak the report is. It seems like the market is looking to see a cooling in the labor market, enough to justify and cement these expectations of a September cut, but not too much cooling that it triggers conversation about recession. And I think that R word is in the background at this point, but certainly could come to the fore if we get a much weaker than expected print today. And then to your point about whether any weakness in the jobs market is going to be down to tariffs and the impact there, that's going to be really interesting because some of the cracks that we have seen come through so far have actually not been tariff related, but have been more tech related, AI related, and will be interesting to see if that trend continues.
Yeah, it was a very interesting point that I think Joe made as well, which I haven't heard a lot of as well, is that let's say the tariff regime is what it is now. I mean, we have to try and take a status quo point at some point, otherwise we just don't know how the revenues are going to oscillate. But roughly we're seeing $20 billion coming into the coffers extra per month at the moment for the US exchequer from tariffs as well. And the big concern has been for all our viewers, for the markets, well, where is this money coming from? And is it going to go up or is it going to go down? Is it going to affect prices in the stores, or is it going to affect margins for the corporates in the earnings season? Is it going to affect spending patterns? But I think Joe made a really interesting point, actually, and that was actually, if they continue at current levels, yes, the importers of those goods, American companies, because that's who pays, as we all have established now, I think we all understand the economics, they will absorb a certain amount before they have different supply chains that will bring down the costs of importing those goods. Therefore, and I'm not using my E word for change, therefore, the amount of revenue will decrease as those companies adapt their supply chains. And I thought that was a really interesting point that I haven't heard a lot of people talking about. The revenue will go down as companies adapt and change their supply chains.
That was really interesting as well. That, but again, I think when it comes to playing this out in markets, it's all going to come down to timing. And Joseph Stiglitz, he very well may be right. Certainly he knows a lot about how this works, and we may well see companies adjust their supply chains and these revenue figures come down over time. But does that mean you should be pricing that in right now? Well, maybe not, because you might be missing out on some upside.
Yeah, and we just don't know because, again, it was an interesting conversation. Look, we must say that Joe's coming at this from a very different constituency. He believes that the tariff regime is very, very bad, and this is creating a chaotic order in the post-Washington consensus kind of way, a consensus which he criticised. I was reading his criticism of it again, as I mentioned, a quarter of a century ago. But the fact of the matter is there's a lot going on, and he also talked about this from a European point of view. Now, Joe told me that the trade deal that Europe has signed was actually not the most beneficial for this continent. We'll listen to this.
They may be making the best of a bad situation, but it's not just about trade. And It's really important to realize. If it were just about trade, you look at the size of the European economy, the size of the American economy, how much Europe trades, how much U.S. trades. Europe should be paid to trade with the United States rather than the other way around. Europe should have gotten the better deal. Europe got a bad deal. Absolutely. But what was this about? Defense. Europe is at war. They know they're at war. U.S. knows that it's war. Europe has not gotten the defense capacity to fight on its own. Everybody should have been aware that the U.S. was not a reliable partner back in 2017 when Trump came to power first, but they didn't take on board that lesson. And this is the best deal they could get. But they should remember, any deal with Trump is not worth the paper that it's written on. And I don't know if you've seen, not long after that deal, it wasn't signed, but it was spoken, whatever you call it, agreed to, the U.S. says, oh, by the way, you have to get rid of all your digital regulations, your DSA, your DMA, your digital taxes in some countries. You have to get rid of all that. All the things that you have tried to do to protect you in the new digital economy. Europe says it's not giving up its national sovereignty. So where does it place you? You made a deal. It was the best deal you could at the moment. But you're going to be back at the drawing board.
Very interesting point. He says the deal was agreed but not signed, and actually since that agreement with von der Leyen and Mr. Trump as well, that the US has been asking for more terms. And we always kind of thought, why wasn't the Digital Services Act brought up in those original conversations? Well, obviously it's coming up now. Look, I also caught up with the CEO of the European House, Ambrosetti, that's Valerio De Moli, and I also spoke to him about how he thought Europe so far had coped with the impact of US tariffs.
Nobody understood the liberation date, who and what liberated. So that's also a question that you should pose to the many other guests that you will be interviewing in these coming 3 days. What happened? A lot of mess, I would say, a lot of confusion, and actually I'm not subscribing to the list of the over-criticism against Europe. Because in the end, what Europe did was their best efforts to reinforce the alliance across Europe and to stay together, aligned in the same position. This is an incredible achievement and result. So at the end of the story, I think that given the personality of the other side of the Atlantic, of Mr. Trump, and all of the confusion the Trumponomics created across all of the world, the distress that was created across the Atlantic and not only with European partners, I think we obtained what was achievable, and let's see what's happening.
So very interesting. You've got the Joe Stiglitz view that Europe could have done a lot better. We're a much more powerful bloc than we give ourselves credit for. And then you've got the Valerio De Moli argument that actually Europe did a pretty good job of keeping most nations on board and actually coming to a cohesive approach. That said, I think there's a lot we all know that Europe isn't doing, should be doing, regardless of tariffs, in fact maybe with tariffs as a catalyst to improve its self-help. And I spoke to Valerio a lot about the self-help side of things, and Julian, I'd be very interested to hear your view on this one as well. But I said, look, we're just not moving quickly enough on mobilising this enormous amount of capital that we have on this continent. Italy's a great case in point. We're talking about billions and billions of dollars or euros of family, of business money that's actually not finding itself a home in growing Europe. It's finding its way to the NASDAQ to support US companies. So growing our capital markets, improving our access to capital, improving our access to private credit and getting that money mobilised to boost the European economy. These are problems. He actually said to me, no, he thinks the biggest problem is that there is still a veto at a Commission level. There is a veto for countries to block the will of the other 26. And of course, we talked a little bit about Mr. Orban, who I interviewed here very briefly about a year or so ago. So he's saying it's the veto that's the problem. Others are saying it's the capital that's the problem. And I spoke to one very big European industrialist this week. I can't name his name because it was a Chatham House private conversation. He said, look, we are still making virtue of the fact at a commission level that we have so many rules and regulations in Europe, that actually we are a bastion of security because of those rules and regulations, rather than actually they're acting as a detracting force. And I thought that was very interesting coming from one of Europe's biggest businessmen. 3 different views there, but I'm interested in what you think, Juliana.
Fascinating, and I think that is a major part of the European psyche, that, you know, Europe for many, many years has prided itself on being at the forefront of regulation, and in some ways that's benefited the continent, but in others it's constrained growth. I think my sense, talking to business leaders on both sides of the Atlantic, is there's so much emphasis put on the Draghi report, and many really use it as a guide and say, you know, if Europe doesn't follow through and take the guidance from the Draghi report, then Europe is really at risk at this moment of falling behind. When you look at where they are on the tech front in particular, they're nowhere to be seen in the AI race, for example, and we're seeing political standstills in France, here in the UK as well, governments reluctant to make some of these hard decisions when it comes to their budgets. But I think and I'll be curious over the course of the day, listening to your conversations, to what extent the Draghi report comes up and still stands as a major guide in the minds of business leaders around the world for what Europe needs to do to improve its prospects moving forward.
Yeah, absolutely. Look, I know we're going to move on at the moment, but I'll just tease out one of my next guests. I'm going to speak to Pascal Cagny, who is, amongst other things, he's the chair of Business France. And if ever there was a country that is at the epicenter of a lot of our historic problems at the moment, and perhaps not having learnt some of the lessons of the last 20 years, it's got to be France as well. So I'm really interested in digging into that conversation about how France and its businessmen and women are dealing with the current turmoil. So that's to come here out of Ambrosetti.
Well, I look forward to the conversation. Meantime, Trump's Fed nominee Stephen Miran says that he is not at all a puppet for the president. At a hearing with the Senate Banking Committee, Miran said the president has made, quote, excellent calls on monetary policy, but that he is ready to hear all possible views. This, as the Fed's independence comes into question amid presidential pressure. The U.S. Justice Department has reportedly taken new steps in its investigation of mortgage fraud allegations against Fed Governor Lisa Cook. That's according to NBC News. It comes after the Wall Street Journal reported that the DOJ opened a criminal investigation into Cook's alleged fraud, focusing particularly on properties in Michigan and Atlanta. Cook has denied the allegations. Coming up on the show, we'll hear from Deutsche Bank on why banks remain one of its most favored sectors. Plus, we'll take a look back on an eventful week in the UK as Keir Starmer's Phase 2 revamp is overshadowed by rising borrowing costs. And we'll bring you even more coverage from Ambrosetti, with Steve sitting down for a conversation, as he just mentioned, with C4 Industries President Pascal Cagny. That's this hour. Welcome back to the program. Let's get a check on markets and the most recent action on Wall Street. Yesterday was a decent day for the 3 majors stateside. All 3 ended the session higher, led by the tech-heavy NASDAQ. When you look across the sector performance, 10 out of 11 sectors were positive in the session, led by consumer discretionary, which gained 2.25%. For the week, the Dow, at S&P, and the NASDAQ all higher. The NASDAQ outperforming up more than 1% week to date coming into today's session. Now, in terms of Asian trade overnight, investors seem to be taking a cue from the positive trade stateside. You've got gains across the board, led by the Hong Kong market, which is up more than 1% at the moment. Nikkei 225 not far behind, up 1% as well. Now, as for European futures, here's the early indication. After yesterday, the Stoxx 600 gained 0.6%. We're looking to build on those gains. It was the second positive session in a row, and we actually had some big swings to the upside for a number of sectors. Media gained 2% in yesterday's session. Telcos also caught a strong bid, up 1.8%. Retail gained 1.5%, so some pretty decent trade. For the week, though, the Stoxx 600 essentially flat. We have had some losses in German and Italian markets offsetting gains in UK markets. Now, we're reaching the end of the first trading week of what has historically been a weak month for stock markets. Here's a look back at the asset class and how Deutsche Bank is looking ahead. Banks were the best performing sector in the Stock 600 over the past 12 months, soaring more than 60%. Deutsche stayed overweight on the sector, saying that apart from short-term pullbacks, lenders continue to beat earnings expectations and maintains a strong fundamental picture. Meanwhile, healthcare was the worst performing sector in the Stock 600, down 15% in the past 12 months. Despite that, the bank double upgraded the sector last week from underweight to overweight, citing reduced U.S. tariff risk, attractive valuations, and strong forecast EPS growth. Well, we are very lucky to have Maximilian Ulier with us, head of European equity and cross-asset strategy at Deutsche Bank. Maximilian, thank you so much for being with us. I read your report when you published it. It caught my eye, and I'm thrilled that we've got you here to talk us through how you're feeling about markets right now, because you've got a few contrarian calls here. Let me just kick off with a broad brush question around cyclicals versus defensives here. When you look at European equities, where do you stand?
Yes, good morning. Thanks for having me. So we've had this political discussion in the program already, right? I was tuning in a little early, and I think that's kind of taking the attention a little bit from what's actually happening underneath. And from an equity lens, things look pretty decent. So you have 3%, I wouldn't use the word recession at all for the US. You have 3% GDP growth in the US. We expect 2% for Europe. You have very solid earnings growth in Europe and in the US. And then back to your point on cyclicals, for the first time in 3 years, we've actually had PMIs in the manufacturing space going back above 50. So we're in a 3-year depression in manufacturing, and that's just coming to an end. We see a similar trend in the US, also recovery in manufacturing activity, especially in sentiment. So if you look historically, there's a very clear pattern. I know it doesn't feel right, and this has been cooking so slowly that market hasn't been paying attention. But the pattern is that once you cross that mark of 50, and we think that's going to last, you have a clear outperformance in materials, manufacturing, and cyclicals more broadly. So I think it's with this very constructive, or let's say at least constructive market view, plus a recovery in manufacturing, I think you should be long the cyclicals. You should be underweight defensives. And you said in your intro that we like healthcare. That's correct. Within defensives, the only sector that we really like is is healthcare, because there are some very special stories within that sector.
Really interesting, and I want to pick your brain on healthcare in just a moment. But firstly, on the underlying thesis here that cyclicals are going to outperform, to what extent is it a headwind that global investors seem to be reconsidering this buy Europe over the U.S. trade, which dominated the first part of the year? We've seen flows exit Europe from the international community and re-enter the U.S. market. Do you think we're going to see a reversal of that?
I actually can't really confirm that. So Q1 was really, really strong for Europe, massive outperformance. H1 actually, if you take the same currency for both regions, because of the weakness in the dollar, we had the strongest outperformance again of European markets versus US markets. And if you look at flows, then yes, flows have been coming down in Europe, but they're still above the levels we've seen in the past years. And in the US, they have re-accelerated, but they are below the levels we've seen in past years. So yes, there is a trend back to tech, but I think we're in a very different world compared to the last 10 years, because the default, and it goes back to your discussion on capital flows, the default positioning of investors for the last 10 years was being overweight US, underweight Europe. Now we're currently technically neutral US versus Europe because of the strength in tech, but the discussion is a very different one. It's now default neutral, and let's give Europe a chance. And we think with the German fiscal coming up, this trend will re-accelerate once we actually see those order intake from the German fiscal. We're now, especially in Germany, you mentioned a few seconds ago that the German market was doing pretty weak this month. We actually think for the next couple of weeks that can be the case, because we're in an air pocket of news flow. We had those announcements of spending, and now we'll probably get them, and that will re-accelerate the interest in Germany and in Europe.
Very clear. So let's dig into some of your sector calls then. You mentioned healthcare, the double upgrade there. This strikes me as quite a contrarian call, given all the concerns stemming from a lot of the administrative attitudes coming out of the U.S. What makes you confident that healthcare is going to recover here?
Yeah, so look, from a strategist perspective, usually healthcare is dead boring, right? I usually don't have an opinion. Most of the time, I don't have an opinion on healthcare because it's a non-cyclical sector. There's very low correlations to anything apart from the dollar maybe. And they have stable and very, very good earnings growth. And usually it's pretty expensive. So this changed this year because we had this political debate on tariffs, and that made us go underweight the sector. Plus, we had this weakness in the dollar, which is also a big drag for those companies because they make most of their money in the US. So this double whammy of tariffs plus dollar weakness made us go underweight. Now, since then, we have more clarity on tariffs. We now think those 15% will hold. 15% is a lot lower than what we've been discussing, which is anywhere from 25 to, at some point, Trump said that could go up to 200. So now base case is 15%, which is a lot more favorable. And the US dollar, yes, it can go a little bit more weak. We think 120 by year end, but let's face it, we're already at 116. So most of the move in the dollar has already happened. So now you're looking at a sector which has historically been very rarely that cheap. So it is cheap. You have better clarity on what's going to happen in tariffs, plus you have lower headwind from the US dollar. So we think longer-term investors should be looking at healthcare right now.
Very clear. What about luxury? This has been a fascinating sector this year, a major underperformer. And in the last couple of weeks, the strategists we've been talking to seem to be becoming tactically more bullish on the sector. We've actually even seen some analysts upgrading single stocks in the last couple of weeks here. And you note in the report that missing out on a bottoming in luxury is potentially the biggest risk in your sector calls. Tell us more, and what would it take to turn outright bullish on luxury?
Yeah, you're absolutely right. And that's one of the stories that everybody's looking at. And there was some short-term data prints like credit card spending, which got a lot of investors and also analysts excited about it. But I'm yet lacking really the proof that something longer term is changing in the sector. I want to see that proof. If you look at consumer confidence in the US, yes, it's not falling anymore. It's slightly recovered, but from low levels. In Europe, kind of sideways. Retail sales we got this week, okay, but actually surprising to the downside. So I'm a bit worried that, there's some hope cooking up without really having that proof. So I will be waiting for that proof. If we get that proof, that's certainly one of the big stories to be owning in H2. Again, too early, it's too speculative, don't jump into it. But now if you zoom out just a little bit for a second, if I may, we've been discussing potential upside in luxury. Again, I'm still neutral. In healthcare, also huge sector in Europe, and we like most of the cyclicals. So, I actually can't really think of a sector that I don't like. There's some sectors that will probably underperform, but generally speaking, I think we have quite a constructive view on markets here.